The war for crypto ETF dominance is not over. In fact, the first phase, the battle for Bitcoin, was just the opening act. The second, more strategic phase is just beginning, and it's happening almost entirely out of sight. While the market remains fixated on the king, a profound shift in institutional strategy is underway. It's built on a controversial theory that the ultimate winner isn't just the biggest asset, but the most efficient. Bitcoin ETFs answered whether institutions would buy crypto. XRP ETFs may answer a far more important question: what they actually want crypto for. What if the data shows they aren't just buying the crypto equivalent of gold, but are now seeking to own the financial rails of the future? In this deep dive, we are not making a prediction. We are conducting a data-driven thought experiment into a potential great flippening, not in market cap, but in institutional purpose. We will dissect the legal breakthroughs, the on-chain flows, and the quiet positioning of financial giants that suggest a challenger, once bound by regulatory chains, is now free. This is a look at what could define the next chapter of digital finance, and why the smart money might be placing a very different bet than you think. For years, the crypto narrative was ruthlessly simple. Get a Bitcoin spot ETF approved. It was the holy grail, the one bridge that would connect the trillions of dollars in traditional finance to the world of digital assets. And when it finally happened, the story seemed complete. Wall Street had arrived, and they came for Bitcoin. But this singular focus was a strategic masterstroke, creating a massive blind spot for the rest of the market. While every camera, analyst, and investor was laser focused on Bitcoin's victory lap, the groundwork for a second, fundamentally different institutional asset was being laid. This asset was emerging from the shadows of a nearly 5-year legal war with the US Securities and Exchange Commission. And here's what most people still miss. Regulatory clarity doesn't just unlock buying. It changes how institutions behave after they buy. The story of XRP is one of a contender, suppressed, not by its technology, but by regulatory persecution. The lawsuit filed in December 2020 effectively made XRP toxic to the American institutional market. While Bitcoin was being fitted for a Wall Street suit, XRP was branded with the scarlet letter of incurable legal risk. And then, in a landmark moment, the script was flipped. The final resolution of the court case in August 2025 delivered what was once thought impossible. The ruling from Judge Annalisa Torres of the U.S. District Court for the Southern District of New York was decisive. XRP, in its sales on public exchanges, is not a security. While some limitations on direct sales from Ripple to institutions remained and a settlement was paid, the ruling was a starting gun. It created the one thing XRP had been denied for half a decade: a clear regulatory pathway in the world's largest financial market. This decision didn't just pave the way for a copy-paste of the Bitcoin story. It unlocked years of pent-up demand for an asset with a completely different utility: a global settlement token. And as we're about to see, the institutional strategy for embracing it could look nothing like what we saw with Bitcoin. Where Bitcoin's ETF launch was a public spectacle, a future wave of major XRP ETF approvals could be a quiet ambush, defined not by initial explosive volume, but by the relentless, steady behavior of its buyers. As of early 2026, while some smaller or futures-based products have begun to trade, the market is still awaiting decisions on spot ETF applications from major Wall Street players. The question on everyone's mind is whether there's any institutional appetite left. But this question misses the point. The metric that truly matters isn't just total inflow, it's flow quality. The real signal of a silent flippening would be in the behavioral data of the funds. Will we see the same pattern as Bitcoin ETFs, with significant outflows on down days as hot money flees? Or will we witness something different? Imagine this: Bitcoin is red 3% on the day. Headlines scream ETF outflows, and yet XRP ETFs quietly post net inflows. No drama, no headlines, just positioning. If a hypothetical XRP ETF shows this resilience, or even net inflows during periods of market weakness, it would be an undeniable signal that institutions are not treating it as just another crypto. This indicates a different investor with a different thesis. The demand appears to be waiting. The ecosystem of issuers is ready, with firms like Grayscale having expressed interest and a history with XRP products. A potential launch could happen against a backdrop of market uncertainty, providing the perfect test of institutional conviction. If the appetite for XRP exposure holds firm while other assets bleed, it would prove institutions see a distinct value proposition, one compelling enough to buy for its utility, not just for its market beta. The challenger is gloved up and waiting for the bell. But to understand why institutions would even consider this, we have to look past the assets and into their own psychology. Now that the stage is set, we have to ask the most critical question. Why would an institution, having already bought a Bitcoin ETF, even consider a second crypto asset? The answer lies in the evolution of institutional strategy itself, moving from simple exposure to sophisticated portfolio construction. For years, the only mandate was to get crypto on the books. Bitcoin was the perfect vehicle for that, a simple, non-sovereign store of value analogous to digital gold. It was a macro hedge, a beta play on the entire digital asset class. Buying it was a vote of confidence in the survival and growth of the ecosystem as a whole. But the game is changing. The approval of a second, legally distinct asset like XRP allows for a far more nuanced strategy. Institutions are no longer just buying crypto. They are building a diversified digital asset portfolio. This is the core of the psychological shift. In this new model, Bitcoin remains the digital gold, the foundational store of value. But XRP is being positioned as something entirely different, a financial utility token. It's a settlement layer designed for the very financial institutions now considering buying it. Its technology is built for velocity, capable of settling transactions globally in 3 to 5 seconds for fractions of a penny, a stark architectural contrast to Bitcoin. Institutions don't see this as a competitor to Bitcoin. They see it as a different tool for a different job. One is for holding value, the other is for moving it. This shift from a single asset strategy to a diversified portfolio approach is the silent catalyst. It's a move from speculation to allocation. But this psychological framework is meaningless without hard data. And when we look on chain, the evidence of this silent rotation is becoming undeniable. This is where the theory collides with hard evidence. A fascinating pattern emerges when you compare the market structure of Bitcoin with that of XRP. A classic story of scale versus conviction. First, the contrast and impact. Bitcoin's colossal market cap means it requires a tidal wave of capital to move the price. $1 billion inflow is a drop in the ocean. For XRP, with its much smaller market cap, every institutional dollar has a magnified effect. That same $1 billion inflow represents a far more potent force capable of triggering a structural repricing. Institutions understand this reflexivity, and the on-chain data suggests they are positioning for it. In early 2026, on-chain analytics show that XRP reserves on exchanges have plummeted to multi-year lows. At the same time, a fascinating trend has emerged. For the first time since September 2025, the number of millionaire wallets, those holding at least 1 million XRP, has been quietly increasing, with a net 42 new millionaire wallets added since the start of 2026. And here's the part retail almost always misreads. This is happening without price confirmation. Institutions don't wait for charts to look good. They wait for asymmetry. Retail investors see a boring chart and look away. An institution sees large, sophisticated holders accumulating during a period of perceived weakness and identifies it as a classic sign of quiet accumulation before a major catalyst. It implies a belief that future demand from ETFs will collide with a shrinking available supply. This is the perfect storm for a potential supply shock. Even a modestly successful launch for major XRP ETFs could have an explosive impact on price. An impact far greater than what the same capital could do to the much larger Bitcoin market. The data doesn't lie. The smart money is positioning for XRP's next chapter very differently. This potential shift isn't just a theory derived from on-chain data. It's being openly modeled by some of the biggest names in finance. While the public narrative is still catching up, the expert class is already positioning for a future where XRP plays a major institutional role. Look at Standard Chartered, a multinational banking giant. Their head of digital asset research has been exceptionally bullish, setting price targets for XRP as high as $8 by the end of 2026. Their thesis isn't based on retail hype. It's grounded in the resolution of the SEC lawsuit and the floodgates of institutional demand that spot ETFs could unlock. Then there is the more measured analysis from asset manager 21 Shares. They've modeled a 2026 bull case price of nearly $2.70, driven by the combination of ETF demand and the expanding utility of the XRP ledger. Their entire framework rests on the regulatory clarity achieved in 2025, which they state fundamentally altered the asset's demand profile. Now here's how this story usually reaches its final phase. There's the elephant in the room, BlackRock. The world's largest asset manager remains officially silent. In a now famous interview, CEO Larry Fink gave a cryptic, "I can't talk about that," when pressed on a potential XRP ETF. While not a confirmation, that calculated response is worlds away from a denial and is seen by institutional analysts as a sign that the topic is, at a minimum, under active consideration. This institutional interest is reinforced by real-world adoption. Ripple has been relentless in building out its utility for the multi-trillion-dollar cross-border payments market. Its RippleNet payment network has been used or tested by giants like Santander, and the launch of a USD-backed stablecoin, RLUSD, creates a powerful, vertically integrated ecosystem. The message is clear. The end of the SEC lawsuit wasn't the end of the XRP story. It was the start of the institutional chapter. This brings the debate to the forefront. We've examined the legal shift, the institutional psychology, the on-chain data, and the expert analysis. Now, I want to invite you into a strategic debate. The future of institutional crypto likely follows one of two paths. Path one is a winner-take-all market, where Bitcoin's scale and legacy inertia make it the only asset that matters. Path two is a diversified, multipolar market, where specialized assets like XRP carve out a permanent, high-velocity niche based on utility. Let me know your thesis in the comments below. Are you on team scale or team utility? More importantly, what is the one data point, be it ETF flows, on-chain metrics, or adoption rates, that forms the core of your argument? This is a conversation the entire market needs to have, and I will be in the comments reading your analysis. And if you value data-driven deep dives that cut through the mainstream noise, make sure you subscribe and turn on notifications. So where does this leave us? We are at the dawn of a potential fundamental re-architecting of the institutional crypto landscape. For years, Bitcoin was the only game in town, the default asset with just enough regulatory safety to attract serious capital. The conclusion of the Ripple lawsuit may have shattered that monopoly. It has potentially created a second pole of institutional gravity in the crypto universe. What is emerging is not a replacement, but a differentiation. Institutions are graduating from simply buying crypto to building a sophisticated portfolio. In this portfolio, Bitcoin is digital gold, a store of value. But XRP is emerging as its complementary counterpart, a financial utility token engineered for the very institutions that will soon be able to buy it through an ETF. The great flippening we've explored is not about XRP's market cap overtaking Bitcoin's tomorrow. It's about a flippening in narrative, in purpose, and in institutional strategy. Bitcoin answered the question of legitimacy. XRP may answer the question of utility. And institutions are now in the process of deciding which answer matters more.